The broadcast is now starting. All attendees are in listen-only mode.
Hello, and welcome to StockValue.com. I think you'll find this a very interesting presentation, and you'll also see some opportunities for yourself to make really good money in the market, even if you're not that much of a knowledgeable person about it. And if you are, this will probably make you cry for opportunities lost. So let's get started. So ask yourself two key questions. One, do you think the stock market is gambling? You know, a lot of people do. And second of all, have you lost a lot of money in the past decade in the market, or at least since the early 2000s? And unfortunately, the answer is a lot of people have been very underwhelmed with the performance on their portfolio. It's either down or flat, and they've lost some very big opportunities along the way. So that is the reason we developed this system. So let me tell you a little bit about my background, stock market dynamics, how to make money in stocks with less risk and bigger upside, which is our goal, and then a little bit about StockValue.com. So my background is I was a Wall Street analyst for 15 years for large pension funds, trust funds, endowments, etc. Working with some of the very largest money managers like Chase, Bank of New York, Drexel Burnham, Manufacturers Hanover, which some of you may remember was a very large money center bank. And I had the good fortune of being able to cover many, many industries across all different product lines, from technology, transportation, industrial-related, consumer-related, entertainment, lodging, etc. So I was able to see how these large money managers handle billions of dollars in investments, which gave me a great window on the dynamics of the market, which we'll talk about in a minute. I had my MBA, worked in the CFA program, and for the last 3 years, I switched and was working with individuals on their separate financials. So I got to see the perspective of the small investor as well very clearly. And so what I wanted to do was really bring to that small investor the capabilities of the large investors so that they don't have to be at the mercy of the market anymore, but can really, in fact, take a stand and make some great returns in their portfolios. So let's talk about market dynamics briefly. I think we've established that a lot of people really sort of are under the impression that the stock market was flat, or at least their portfolios were flat in the last decade and maybe appreciated somewhat very recently. So ask yourself, do you have more money than you did in the early 2000s? Is it a substantial amount? Probably not. Has your retirement suffered? That's what I kept hearing from people. Or did you make 20% plus a year, which is what I'm going to show you how to do. So let's look at the stock market as measured by this S&P 500, which is S&P creates indexes. So these are 500 stocks, which give us a pretty good view of the economy. It's everything from energy to financial stocks, consumer-related, industrial, so forth and so on. So the time period we're looking at here is from the early 2000s to the present time. What do we see? Well, we see, in fact, the market was not flat at all, although we can maybe see how people arrived at that conclusion. But along the way, there have been some very big peaks and valleys, some very big opportunities to make money inside of this period of time. So what we see when we look at the market is very big money managers needing months to move money into and out of a stock because they're moving, maybe a position of $100 million at any given time, and they don't want to impact the price of the stock. So they have to be very clear that they know when to get in and what their target is 12 to 18 months down the road. And the reason we say 18 months is because if you're in the middle of a year, the stock market really looks out 6 months at any point in time. So you're looking into the following year. So we have to take that into account. Now, money managers will be lightening or selling positions within 10% of the low end of this target range in order to move money into stocks that have more upside potential. And this really makes prices swing up and down from undervalued to overvalued because they're getting out within the top 10% of the upside to be able to move that money into, as we said, other stocks. So they're selling as it gets near the the top, and they're buying as it gets near the bottom end of these ranges. So what we want to do is to be able to calculate for ourselves kind of where they think these ranges are. And what we find is that what I call this the pendulum swinging theory. If we look at that fixed point we can surmise that actually there is an intrinsic value to a stock price. And what that is estimates of what earnings the company is capable of generating over each of the next 10 years, and bringing that information back into the present, and really using that as our intrinsic stock value. So the stock prices trade around that range from undervalued to overvalued, as we were just discussing. So let's take a look at an individual stock. Well, we have Qualcomm from 2004 to the present. Now, it's a little hard to read on this, but in 2004, Qualcomm was at $30 a share. And today it's sort of hovering around $60, let's call it. So you're probably saying, gee, I wish my money manager put me into that, because it's doubled. But if we look a little closer, we do a little analysis, and I don't know if you're familiar with the rule of 72, but essentially if you divide the number of years into 72 that you're looking at, that will tell you how much per year your appreciation has been. So this is actually 9 years. So 9 into 72 gives us 8. So Qualcomm has, on average, gone up 8% a year. If we held it that whole period of time, we would have made 8% a year, which is really not bad compared to a lot of other stocks, compared to even opportunities we have today. For example, CDs that earn less than 1%. However, my friends, take a look at this. So what I did was I went back, and each year I made a note of where the stock sold on the low end and where it sold on the high end. And the column in blue numbers shows us what that appreciation would have been each year had we bought it at the low end and sold it at the high end. For example, 2009, the low end was $32 a share. It went up to $49 a share. We would have made 53% return on our money had we known where those 2 points were and taken advantage of them. The column in red shows us the declines per year, and we would have been able to avoid those had we actually been able to sell near the top end of the range. So you can see there's a significant amount of volatility in these stocks that can give us super returns if we take advantage of them. Let's look and see if that's the case for other types of stocks, not just tech stocks, but maybe a drug company, Johnson & Johnson. And I think we see the same thing. If we look at our blue column, we see returns annually that range from, let's say, 15 mid-teens on the low end up to 40% or more on the high end. Here's Costco. Costco is a consumer-oriented company. Even bigger returns there. We can see they're in, I don't know what that average is, but let's say 30%, 40% per year. Are you starting to get the picture? Are you unhappy with flat returns? Let's look at Pepsi. Pepsi might be considered kind of a stodgy company because it's been around a long time. It's a relatively slow grower. But in fact, we see enormous opportunities for stock appreciation inside each year. 2009, 47%, 2008, 61%, 2007, 28%, and so on and so forth. Here's CSX, which represents the industrial side of the economy. CSX is a railroad. It carries a lot of autos and coal and lumber and that sort of thing, raw materials, natural resources also. So look at the opportunities each year for CSX. Those numbers are significantly large. So 50–60% you can make on your money if you were able to identify, again, the low and the high end ranges. So stock value program is actually based on taking advantage of the swing in most stocks price from undervalued to overvalued. We look at key valuation parameters, which I'll touch on in just a moment. We track our high and low target ranges, and then we act when stocks hit these ranges or within, let's say, 10%. So we buy on the low end and we sell them on the high end. And my friends, you will be really shocked at how consistently we can gauge these ranges each year. And we also reduce our risk when we buy near the bottom end of the ranges. So what are some of these key valuation variables? Well, they are actually the operating information on the stock, everything from the revenues or sales per share, earnings per share, cash flow per share, what we call the book value, which is the shareholders' equity per share, dividends, and then look at it relative to the other stocks in the S&P 500. Just to tell you what shareholders' equity is, I think a good way to explain it is to think about a house. You might have a mortgage on the house. That mortgage on the house would equate to the debt companies have on their balance sheet. And everything else is what the owners own in that house as well as in the company. So book value and shareholders' equity are the same thing, and we look at that again per share. So here's an example of Pepsi. Looking at the price of the stock and dividing it by their book value per share every year, and are we amazed? Look at this consistent trend lines and gaps between them. That's where our appreciation occurs. So let's just say if we bought this somewhere over 4 times book value every year and sold it a bit over 5 times, we could pretty well track some really good performance. Here's Johnson & Johnson looking at their relative price to earnings ratio. Again, if we bought this, let's say, close to maybe 7 times earnings relative to the market and sold it a little bit around 9 times, we could be pretty assured of having good returns, like we were talking about earlier. Here's Costco. This is looking over a longer period of time, back to 2003. And these lines wiggle a bit, but the main reason they wiggle a bit is because the 2008-2009 was an unprecedented crash in the market, I'm going to say. And what do we see? We see the ranges getting back up to a more normalized range. So if you will, if we bought this around 12 times price to cash flow and had a target of over 16, we would be able to make that spread pretty consistently. So let's look back. In the early 2010 period in April, I started writing a blog, and what you can see here is my notes from that period of time. We said eBay we felt was very neutral at $26 a share because we thought the price range would be from the low 20s and to the low 30s. And in fact, that is pretty much where the stock sold over that 12 to 18 month period. MetLife. At $47, we said it looks neutral, an expected range of 32 to 52. Again, a bit hard to read, but it basically traded on the low end between 30 and then the high end in the high 40s. So, you know, this would not have been an opportunity to make a lot of return unless we waited till it got down to the low 30s and then we bought it there. Urban Outfitters in May of 2010, we said at $36, it looks a bit extended. Our price range was 22 to 36, and in fact, it traded down to just about 22. From the high end was about 38. So had we owned this thinking we were going to get great appreciation, we would have been very disappointed. So the stock value program, just to review, is designed to take advantage of the knowledge of annual stock price swings and make money off of these. It helps us see the trends that can greatly increase our returns and reduce our risk by buying near the bottom. It provides a very easy methodology to calculate these valuation ranges. And finally, it gets us in the heads of the big fund managers and lets us benefit from their actions rather than be at the mercy of them and sell at the bottom and buy at the top. Ask yourself, what if? How much farther ahead would you be today if you used this methodology years ago and continue to use it? Imagine you're going to the racetrack. Wouldn't you be much better off if you knew ahead of time which horse was going to win? So it's really that simple, my friends. You'll know ahead of time. Stock value is really worth $295, and we currently have the market on the market for $99, which you can see on this site. That's a very small amount to pay to unlock some very serious returns. If you have questions, you can email us at info@stockvalue.com. We recommend using it in your IRA, your Roth IRA, for maximum returns and low tax impacts. So tell your friends, make money together, and have a great time really seeing your retirement appreciate from here on in. Thanks for listening.